I'm portfolio manager. We run several funds. One of our funds is a gold fund, so it's about protecting purchasing power. When asked how would I value gold, we look at it from the basis of monetary base, the global monetary base, and also credit aggregates. So you can make a case that if we had a 40% backing of gold to the monetary base, that we could come up with a price nearer to $4,500, and markets obviously overshoot. Now, if we were to look at the credit aggregates, we come up with astronomical numbers because gold has been left behind in this era of credit proliferation. So that's how we come up with the numbers. So perhaps not quite as exciting as a trade. I'm more interested in the purchasing power.
Now, how long, okay, if we want to define a trade as 1 month, it's clearly not that. If we want to define a trade as 5 years, it's another definition. How long does it take to actually get to $6,000 in your scenario?
Well, I don't call a trade 5 years. I consider a trade in weeks, months maybe. But in terms of what's happening in the backdrop of the world economy, I see huge deleveraging trying to take place, but obviously central banks are trying to ameliorate that. But we have a highly disinflationary environment, and really it comes down to at which point, or at some point, the central banks are going to be the only buyers of bonds in the market, other than perhaps the private sector pension funds who might get forced under financial repression to buy these bonds. So I think in that environment we're going to see wholesale exits out of bonds into gold and cash, and in that environment there's just really not enough ready supply at these current levels for that transfer to take place. So I can see that over the next 2-3 years that we start migrating to those prices, but I don't see gold particularly above 2,000 by the end of the year. But this is an extremely volatile time that we're living in, so anything goes. But I would say that we've acquiesced and over this year, and we'll migrate to 2,000 by year end.